Oh, wait. Let's unpack this. For years, Thailand's been kind of whispered about, in investment circles, like this hidden gem for property investors. And often there's this hint, this enticing hint of massive tax advantages. So, our mission today is pretty simple. We're diving deep into the actual Thai property tax landscape for foreign buyers. We want to figure out if those supposed advantages are, well, real today or just sort of a myth based on old info. Now, before we go any further, let's get the geography right. It's important. The place we're focusing on, the luxury real estate hub, is Phuket. That's Phuket. Pronounced Phuket, definitely not Phuket. Getting the details right, well, it starts right there with the name. And our insights today, they're coming from real market experts. We've got this excellent guide from Ocean Worldwide. They're a high-end luxury residential real estate agency specializing in Phuket and also Koh Samui. And they've been in this specific market since 2004, so a long time. We'll be leaning pretty heavily on the expertise their team has built up, including their director, Sandra O'Neill. Apparently, she spent decades helping, families and investors navigate these exact complexities.
Yeah, and what's really fascinating here is how that whole tax advantage myth thing really comes from what Thailand used to be like. If you're basing your whole investment strategy on info from before, say, 2019, well, you're building on some seriously shaky ground. The whole regulatory landscape just fundamentally shifted under everyone's feet. So our goal today is to make sure you, the listener, avoid leaning on those, frankly, outdated assumptions. They're just costly pitfalls now. And the initial synthesis, looking at the Ocean Worldwide data, it points to two immediate truths for foreign investors. First, yes, direct land ownership is still heavily restricted. That hasn't changed much. But compliance now, it hinges completely on understanding the Land and Buildings Tax Act of 2019. That thing was revolutionary. And second, because things change so fast and it's pretty complex, getting professional, localized advice isn't really optional anymore. It's absolutely the cornerstone of a decent investment.
Okay, let's maybe challenge that just a bit. Why did people even believe that myth, the huge tax advantages myth? What was the loophole or the reality before that 2019 Land and Building Tax Act kicked in?
Right, well, before 2019, the old tax system was, frankly, pretty gentle for a lot of property owners. It was mainly based on the income generated, like rent. So if you had, say, a luxury villa in Phuket that just sat empty for 9, 10 months of the year, your annual property tax bill was often tiny, minimal, sometimes almost nothing. That's where the myth came from. It was kind of true back then.
Ah, okay. And that's exactly what the 2019 Act flipped on its head. It massively expanded the tax base. The Act now applies to anyone who owns or, crucially, uses land and buildings. Doesn't matter if you're making income from it or not. So, that amazing holiday home you bought in Phuket, the one you only use for a few weeks, you are now absolutely liable for annual property tax on it, even while it's sitting empty.
Exactly. It totally shifted the focus away from income toward just asset utilization. How is the asset being used or not used? And if we link this new setup to the bigger picture, well, this is where that main hurdle for foreigners, the block on direct land ownership, gets even trickier. Because you often have to use something like a Thai company's structure to hold the land. Now you're juggling two different sets of rules at the same time. The new property tax rules and all the complexities of corporate tax rules.
Right, so it's layered now.
Very layered. And this is probably a good moment to debunk a really common misconception. Owning property through a Thai company, it is not some magic tax shield. Absolutely not. All it does is shift where your compliance burden lies. You're not dodging tax. You're just navigating it through corporate regulations, which honestly can sometimes open you up to more scrutiny, especially if that company looks like it's not quite legitimate.
Okay, this is where it gets really interesting for me. The tax is based on utilization now. So the actual rate you pay each year depends entirely on how the property is classified. And it's progressive.
That's the core of it. Progressive based on use.
Right, so let's outline that structure a bit. Lowest tier is agricultural land. Rates there are typically capped at, what, 0.15%? Pretty low. Then you've got residential properties, that's your home, your condo, generally taxed up to 0.30%, still relatively modest. But then if the property is classified as commercial, or, and this is key, unused land, the rates suddenly jump a lot, potentially up to 1.28%.
Yeah, that difference is huge. Think about it. Say you own a plot of land in Kamala on Phuket. If the local authorities classify your beautiful private villa as residential, okay, you pay up to 0.30%, manageable. But what if you decide, I'll rent out a section commercially, or maybe you just leave the land undeveloped for a while. Boom, you could suddenly be looking at a tax rate 4 times higher, up to 1.20%, just based on that classification.
That classification, that really does sound like the potential minefield for an average investor, doesn't it?
Oh, it absolutely is. And this brings us right back to compliance. The annual assessment, the payment deadlines, they're set locally by the municipality. They can vary slightly, but they are totally non-negotiable. Miss those deadlines, and you start racking up some serious penalties fast.
So you need to be on top of it.
You really do. And your ability to prove how you're using that property. Prove it's actually your residence, not some hidden commercial operation. That ability depends entirely on keeping meticulous records. It sounds boring, but it's crucial. Good records just make tax time smoother, and they help you argue your case for the right tax bracket, usually the lower residential one. We've genuinely seen investors save thousands just because they had clear records proving how they used the property.
Okay, so that covers the cost of just holding the property year to year. What about income? Let's say you decide to rent it out, you're a non-resident landlord. What happens then?
Okay, so rental income for non-residents. Generally, the Thai Revenue Department applies a 15% withholding tax, WHT, right off the top of that income.
15%, okay. But is that necessarily the final amount you pay?
Not always. That 15% WHT is often just a prepayment, essentially.
Yeah.
If you hold the property in your own name, not through a company, when you file your annual personal income tax return, all your allowable deductions get factored in. Things like repairs, management fees, and depending on your overall income and your final tax bracket, you might actually end up owing less than that 15%. You could even get a refund sometimes.
Right, so the deductions are key. What can a non-resident claim?
Well, the source, OSHA Worldwide, highlights the important ones. Definitely repairs, any maintenance costs, fees paid to a property management company, and depreciation is a big one too.
Depreciation, okay.
Yeah. So the old advice is spot on here. Keep every single receipt, especially for the big stuff. Like if you do a major renovation or replace all the appliances, it adds up.
Makes sense. Keep your receipts like you do for your household accounts back home.
Exactly. Now, what's quite fascinating, a more advanced tactic for really optimizing your yield, is this strategy of splitting the income stream.
Splitting it, how does that work?
Well, instead of just charging one single amount for rent, some sophisticated owners will actually separate out the charges. So one charge for the actual property, another for the furniture package, maybe another for included services or utilities.
Huh. Why would you do that? Does separating it change the tax rate somehow?
It potentially can, yes. But honestly, this is where the water gets a bit murky. You need good advice. The idea is that separating them might allow different income streams to fall under slightly different tax rules, maybe offering some benefit. But GAT, and this is a really critical nuance alert, if the company holding your property is registered for VAT, then you absolutely must apply the 7% value-added tax to the income you get from those services or furniture rentals.
Okay. So it's not straightforward.
Not at all. Understanding that balancing act, the interplay between income tax and VAT, it's vital if you want to really maximize the yield on, say, a high-end villa in Phuket or Koh Samui. It's definitely an expert-level strategy.
Okay, let's jump ahead now. End of the investment cycle. You decide to sell the property. Exiting an investment in Thailand. Those transfer taxes can take a serious bite out of your profit, can't they? We should probably clarify these sort of hidden costs of selling.
Yeah, they can add up quickly if you're not prepared. We can basically break them down into two main types. You've got taxes related to profit or business status, and then you've got the standard transaction fees.
Okay, let's start with the profit or status related ones.
Right. First up is the withholding tax, WHT again. Now, if it's a company selling the property, it's usually a flat 1%. That's 1% of either the registered sale price or the government's appraised value, whichever one is higher. Simple enough. But if it's an individual selling, the WHT is progressive. It's calculated based on how long you've owned it and what the tax office presumes your profit is. More complicated for individuals.
Okay, 1% for companies, progressive for individuals. What's next?
Next is the one people often worry about, the specific business tax, or SBT. It's a hefty 3.3% of the sale value.
3.3%. Ouch. When does that apply?
That's the tax aimed mainly at, sort of, short-term flippers.
Huh.
It typically only gets triggered if you've owned the property for less than 5 years, or If the sale is clearly seen as part of your regular business operations, if you hold it long-term as a personal asset, usually 5 years plus, you generally avoid the SDT.
Ah, so holding longer term helps avoid that big 3.3%. Good to know.
Definitely. Now, moving on to the more standard transaction fees. You've got the transfer fee. This is a standard 2% of the government's appraised value.
2%. And who pays that? Buyer, seller.
Well, it's often split 50-50 between the buyer and seller. That's common practice. But importantly, that split is highly negotiable, especially in private resale deals, maybe less so with brand new developments. It needs to be agreed upon.
Got it. Negotiable. And the last one?
The last one is stamp duty. That's 0.5% of the appraised value.
Okay, 0.5%.
But here's the critical point about stamp duty. You usually only pay it if you don't have to pay the SBT. If that 3.3% specific business tax gets triggered, the 0.5% stamp duty is typically waived. You don't pay both.
Okay, so it's usually either SBT or stamp duty, not both.
Correct. Which raises a really important practical point. Who is paying exactly what, especially that 2% transfer fee, needs to be crystal clear before anyone signs any sale agreement. You absolutely must have total clarity on who covers which cost. Getting it wrong or just assuming how it'll be split, that leads to serious arguments, financial pain, and delays down at the land office when you try to complete the transfer.
Yeah, sounds like something you want sorted up front. Avoids major headaches.
Well, absolutely.
Yeah.
That bit of due diligence saves so much trouble later on.
Okay, let's maybe pivot back now to that fundamental issue for every foreign investor, actually owning the land.
Right, the big one.
The reality hasn't changed much, has it? Foreigners generally cannot own land outright in Thailand. End of story, mostly. You can own buildings, you can own condos, you can own structures on the land, but not the land itself.
That's still the basic rule. There are some exceptions, like Board of Investment privileges, but they're usually complex and not really practical for your average individual buyer looking for a holiday home or investment condo.
And this reality, of course, is what's pushed countless investors toward using that Thai company structure we talked about.
Exactly. It's the common workaround.
But we need to stress the scrutiny this attracts now, right? The government is actively cracking down on companies that look like they're just shell corporations. Companies set up purely as fronts, often using Thai nationals as so-called nominee shareholders, just to get around the foreign ownership laws.
Yes, they are much more alert to that now. So what does this really mean for your investment if you go the company route? It means that if you use a corporate structure, that company absolutely must be demonstrably a legitimate business operation. It needs to show verifiable activity, have proper accounting records, and have genuine business objectives beyond simply holding one property asset.
So it can't just exist on paper to hold the villa title.
Pretty much no. Think of it like a company car analogy. If you buy a truck through your business, but there's zero evidence you ever use it for actual business transport, well, the tax authorities are going to question that deduction pretty quickly, aren't they?
Right. Makes sense.
It's similar here. If your property holding company in Thailand has no other real business activities, no employees, no genuine business income apart from maybe some rent, it risks being flagged and potentially classified as an illegal setup designed purely to bypass those foreign ownership restrictions.
Which could have serious consequences for your ownership.
Exactly. And that's why getting advice from legal and tax professionals who specialize in the Thai system isn't just recommended, it's frankly non-negotiable if you're using a company structure.
Wait, hold on. If the tax law itself is public knowledge, why can't just a good local accountant handle all this? Why the emphasis on lawyers or specialized firms like Ocean Worldwide?
That's actually a really good question. Your accountant is brilliant, essential even for the compliance side. Filing the actual tax returns correctly, making sure payments are made on time, handling the numbers day to day. But a lawyer or a specialized real estate consultant like the team at Ocean Worldwide, they address the structural and legal risks. Things like setting up the company correctly in the first place so it looks legitimate, drafting the sale agreements properly to cover things like who pays the transfer fee, ensuring the company's stated objectives are robust enough, structuring that income splitting legally.
Ah, okay. So it's different skill sets needed.
Totally. You really need both to manage the operational side, the accounting, and the underlying legal risks of the structure itself. The complexity now just demands that kind of cross-disciplinary expertise.
Okay. So let's try and summarize this deep dive then. The whole idea of these huge blanket Thai property tax advantages.
Yeah.
And it really does seem to be a myth, especially if you're thinking based on the old pre-2019 rules.
It's definitely not a free-for-all anymore.
Right. But it's not necessarily bad news either. It's more an opportunity for, let's say, optimization. Managing your obligations seems entirely possible with good compliance, keeping those clear records we talked about, and smart planning based on the current laws.
That's a fair summary. And we've established that the path for foreign ownership often still involves using a corporate structure. However, as we just discussed, that route brings its own risks, particularly the risk of government scrutiny if that company doesn't look like a legitimate business operation.
Right. The need for it to be a real business.
Exactly. So maybe we can leave you, the listener, with this final provocative thought, especially if you are considering using a corporate structure for your potential Thai property investment. How will you ensure that the ongoing business activity of your holding company is genuinely robust enough? Meaning it's actively generating real business revenue, it has operational costs, it looks and feels like a proper business. How do you make it robust enough to legally protect your property asset, stopping it from being classified as just an illegal vehicle designed solely to get around foreign ownership laws?
Hmm.
It's a really fine line, isn't it? Where legality and compliance meet. And getting the answer right pretty much determines the long-term safety of your investment.
That is a truly challenging question, something any serious investor really needs to think through carefully. And that need for proactive structuring, for compliance, it just underscores again how vital it is to talk to specialized experts before making that final investment decision. Definitely review your notes on those progressive tax rates based on use and the absolute necessity of meticulous record keeping. Until next time.